Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. They are out of Glastonbury, Connecticut. You can find them online at www.frplan. FRPlan. F as in financial, R as in resources. That's the company that he owns. frplan.com. Write this phone number down, and more importantly, use it. 860-657-8380. Again, 860-657-8380. Good morning, Mark.
Hi, good morning, Gary. How are you?
Man, you know what? I've been busy. As we get closer to the Christmas, a couple weeks away, less than that now. I'm trying to get a lot of things done so that I can just, take it easy the last week. But of course, that creates a little bit more stress and a little more, running around, so to speak. I don't know how things are with you, but that's what I've been up to. What about you?
Yeah, it's pretty much the same. There's a lot of scribbling that you have to do year-end. But looking up to wrap up a record year, an amazing year.
That's great.
A lot of new clients, a lot of change at the firm where I shouldn't say a lot of change. What's great is that we operate similarly, just that I've changed my role from owner to employee, from employee to owner.
Because you bought your partner out earlier, right?
Yeah, and he's still with us, and he's actually actively helping me with the transition.
Lucky.
Which makes life so easy. And we did a very good deal between the two of us. We're not arguing, we're not fighting, we're not butting heads. There's a few changes that I'd like to make, but I already did some streamlining and created a lot more efficiencies when it comes to paying bills, and and other things in terms of automating things. So it's great. I couldn't be more excited. I couldn't be happier.
Good.
I'm in a great position, and we're going to continue to strive to always find the best possible solutions for our clients, to reject the cookie cutter package product deals that people are getting at some of the larger firms. And we are going to be precise and innovative and give you things that you're never going to find anywhere else. So that's what I'm here to do.
Well, that's great. I mean, that's exactly what we want to hear. I mean, let's kick off. Let's kick things off with year-end tax strategy. I mean, what was today? The 13th. We got, we got 2-3 weeks before we start the new year. I don't know where the time has gone, but it's we're just weeks away from 2026. What are some of the key moves that people should be considering right now in order to minimize their 2025 tax bill?
Well, there's no time to procrastinate on this. So 860-657-8380 if you're in a jam. I'll be working through the end of the year, so I'm not going to be taking that trip to Florida or taking off for the last week of Christmas and the first week of the year. You don't take that last week?
A lot of people, they take that week off.
Unfortunately, good news, Gary, is I've always been trained to work hard while the competition's sleeping. So I'll be available the week of Christmas. I mean, I'll probably take some days off there. But I will be available that week. I'm going to be around. I'm not taking off on a plane, and I hate traveling during the holidays anyway.
Well, because it's busy.
Yeah, I'm going to go away when it's not so busy.
Okay.
So,
well, it's crunch time for a lot of people.
Yeah, there's a lot of very obvious what I'll call the vanilla version of tax savings. But let's just go over it. Then I want to talk about some more not complicated, that scares away the audience. I want to talk about some more complex strategies that can be utilized, that are legal, IRS compliant, backed by IRS lawyers, IRS attorneys, legal attorneys is what I'm trying to say.
Yeah.
People who are tax lawyers I'm struggling to find the word. You need to talk to someone who understands the tax law, and tax lawyers. Your CPAs are great. Some of them give awesome advice, but tax savings is not usually their full-time job. They're very good at telling you how much you owe. They're very good at being precise. They're very good at accounting for the things that you've done. But in terms of different tax strategies, I would say your average CPA doesn't really get anything going beyond, your 401k plan or making charitable deductions or things of that nature. But I want to go over some of the basic things. And the first thing that we like to talk about here is obviously offsetting capital gains and losses. So you can go into your portfolio, and if you can offset your gains and losses for the year. If you have a large gain in your portfolio and you need to liquidate, you probably just want to wait till after January 1st. But you want to, what they do, what's called the tax loss harvesting. So tax loss harvesting is when you actually go into your portfolio and you look for losses in that portfolio. Okay, there are these little red brackets. Little red bracket says I have an unrealized gain, I have an unrealized loss. And what you can do is take those unrealized losses and realize those losses. Now, if you really like that stock and you think, okay, it just had a bad year, but it's going to be a home run next year, great. You can actually wait 30 days, on the 31st day, and buy it back, right? So you don't get what's called a wash sale. You can go in and buy it. But there's a whole nother realm of tax loss harvesting that a lot of people aren't aware of, is when you go into your account, you look at your cost basis, there's a thing called detailed cost basis, and there's a thing called tax lots. Mm-hmm. That's what we like to dig into. So when people send me their tax basis, I get the whole file, and we go in and we can really drill down and lower those tax bills. We can really drill down and lower those concentrated positions. Most recently, I had a client who, their Microsoft, I inherited this account from another advisor. Their dad had passed away. So thankfully, we got what's called a step up in basis, okay, meaning when someone passes away, it's their date of death is what the cost basis of the stock was. The stock had still run up 20% from that point. So they had a big, not only did they have a big tax problem, they had a $1.2 million position in Microsoft on a $2 million portfolio. 50% of their money's in Microsoft. So I said, hey, let's pare this back. That was about 5 weeks ago, October 31st, right before Halloween. Okay. And here's what I did. I went in, and instead of just blowing out all the Microsoft and saying, hey, pay the bill, be happy, we went in and we looked at her entire portfolio. Now, the bad part was all those other positions were way smaller than Microsoft, but there were other positions in there. What I was able to do without very little tax consequences, liquidate about $400,000 in that Microsoft position to pare it back, and use some of the other stocks in her account losses and create losses to offset the gains on the Microsoft. So now she's got a more diversified portfolio. Her money's in a better position, and she didn't have a big tax bill to do it. And all we did was right-size the account. So we still have more work to do, but still it's something to where now look what just happened with Microsoft recently. ChatGPT came out with some news that they're falling behind at Google. People are questioning the AI trade. Microsoft has kind of sold off a little bit. So the timing worked out that because, at first she's like, I don't want to sell Microsoft. It's a darling. And I'm like, well, I think we take a piece of it. So she agreed to sell 400,000 of the million. Mm-hmm. And guess what? We probably saved a bundle of money just because Microsoft had sold off a bit. So, even Microsoft is vulnerable in a market like this that trades at these. So you have to be prudent, but you have to be hands-on. You can't just be,
right.
You don't want, you have to be hands-on. And I had to sit down and do that manually. It took about an hour. But that hour saved my client a ton of money in tax, ton of money in market potential losses. And, Microsoft will probably grow back to $1 million at some point, given the future.
There's a lot of people right now. They are dealing with these big one-time windfalls this time of year.
Yeah.
Company buyouts, right? RSUs vestings, stock option paying off. So what do people typically do when they get that large bonus? And
pay the
what
piper?
should they do instead? Maybe is the better question.
Well, I've gotten several calls from people. I'm in Glastonbury, so there's a lot of I didn't realize that there's a big pocket of technology company people, tech employees in my town. I don't even know where their offices are, but because of remote work or whatever. And I've had people call me telling me, they're going to have these big bonuses. They get paid in stock options, which then goes through your W-2, right? So they this thing that's called a Code V. And when you do the W-2, you're saying, oh, my God. And then the W-2 will supposedly withhold some of the taxes, but it's never totally accurate because then there's other options that they were granted that are non-qualified, meaning they're not tax sheltered. Mm-hmm. And then there's others that are inside their 401k plan. Those are, and then there's other kinds of options that they get that are kind of like options, what are called RSUs, which are restricted stock units that vest over 3 years. So you'll get granted RSUs at, say, $30 a share. The stock goes to $50. Now that 3-year cycle comes up and you have to cash out a third, and a third over time. And now all of a sudden, on top of your regular income, which if you're at that level, you're probably earning, let's say, a salary of, let's call it $250,000 to $500,000 base salary. Then you get your bonus. Now you add another $250,000 on top of that, or another $500,000 on top of that.
Wow.
Now you're at $1 million. I had someone call me with their stock options and the regular bonus. They're going to have $1.5 million. Now you're looking at a big tax bill. So what do you do? Right. So what we do is we work with folks on a tax strategy to help them. Obviously you can put, max out your 401k, but that's what, $23,500 if you're under 50. That's not going to put that big of a dent in it.
How many tax strategies do you have?
There's over 30 recognizable tax strategies that people can use.
What are some of your favorites then?
Well, there's one that I'm utilizing now. This is not for accredited investors. There's some that are for accredited investors. And this is a really cool thing. So let me talk about charitable donations, by the way, because that's another thing you can do. So for people who are over 70 and a half and they have what's called the required minimum distribution, they can do what's called the QCD. And that QCD will then allow you to give that money direct to a charity, and the money will not be taxed.
Okay.
Wow. You don't get a deduction on it, but your money's not taxed. So if you had a $30,000 RMD that you don't need, you give that to your favorite charity, then you don't pay tax on the $30,000.
Nice.
If you want to do a direct donation, some people like donor advised funds. Those tend to be a little bit more specific if you want to tier your donations, or but get a big upfront tax break. But just to do a direct donation, cash donation, you get a 60% write-off. So if you give cash to, let's say, your favorite charity or alma mater, if you give $100,000, you're going to have a $60,000 Schedule A deduction, itemized deduction on your tax return, which is nice, 60%. If you donate stock, you can donate stock that has a big capital gain in it, and you avoid the capital gain when you donate the stock, and you get a 30% deduction on that. So for people that don't want a complicated strategy and they have more money than they know what to do with, and they're just trying to get rid of money, basically, they've done all their gifting. I actually did a hybrid strategy where we took half the donation in stock and half the donation in cash, just because they didn't want to deplete too much of their cash, but they had a god-awful amount of stock. It was an S&P 500 index fund. So what we did is we split it 50-50. I went into my software, and because at a certain point, if your income, you can only do 60% of your adjusted gross income. So if your adjusted gross income was, in this case, call it $350,000, right? So the max donation was 60% of the $350,000. So that's what we did. We just exceeded it. So that's a simple, very vanilla strategy that's been around for decades and everyone knows about. And a lot of people utilize that for their favorite charity because they just don't need the money and they're generous. Now, there's other strategies that you can utilize. There's one that we're working on now called charitable minerals that we've done a lot of research on. So these minerals are really interesting. It's a family office. They bought this ton of this volcanic ash. It's off the seabed in Utah. Okay. Now this sounds a little shady, but it's not. It's been vetted. It's clean. And what I'll be doing is for every dollar you put in, you get 5 times a deduction.
Wow.
But it's the 30% limit. So what happens is they create this Master Series LLC, and then you have what's called the Sub-Series LLC. You become a member of the Sub-Series LLC. And what you do is you put in your money, your $25K is the minimum. And then what they'll do is they will then have they'll take the volcanic ash they have on the books and they donate it to a charity. Okay, that uses it to make plastic bottles, whatever they're going to use it for. But the charity will then give you a deduction of $125,000. So that charitable. So if you do the math, $125,000 times the 30%, you're going to get a nice charitable deduction. And that's been around now for a while, since about the 2000s, and it's a really innovative strategy. That, again, the family office is – and what's great is if you get audited, Gary, they have audit protection. They have lawyers on staff, and there's audit protection. The other thing I'd say is if you lose the case, they'll just donate more of this ash because they have so much of it. But the value of the ash in the ground is not the same as when it is in the marketplace. So they have appraisers that, go out and they appraise the value of the mineral, and that's it. And then you get your write-off. So those are the type of tax strategies we use where there's leverage.
Wow, I never heard of that.
Well, you won't. Big corporations know about all this stuff. Tax lawyers know about it. Tax strategies, tax strategists know about it. These are advanced tax planning tools. But some of the things that, by the way, we do, you need to be an accredited investor, by the way. So I want to make that very clear. This one you don't. How
do you help high-income W-2 employees and business owners build like these ongoing plans to lower taxes and save more and even reinvest?
Well, basically, what we're doing is, again, we're utilizing a tax strategy that the client's comfortable with that meets their situation. So for some people,
more of a holistic approach.
Well, of course. But every strategy we utilize, Gary, some strategies are better to offset capital gains. Other strategies are better to offset ordinary income, and some are great at offsetting both. So another one that we utilize, which I like a lot, is there's an equipment leasing product as well, where you would then put down, I think the minimum, let's call it $50,000 is your contribution. You then go out and you get an equipment leasing loan, which takes time. You got to go through underwriting. It's a little bit tricky. But you then will buy $500,000 worth of equipment. Now, based on the new rules, it's called the IRC 179. You can actually write off all $500,000 of that equipment in that year that you do it. So now you get a negative $500,000 in immediate expense. You can expense up to $1 million against your income, right? And then what happens is they will lease. There's a company that will lease the equipment on your behalf, and then you will get a royalty from that lease. And at the end of 6 years, the company actually in the contract guarantees you that if you want to get out of the equipment, they'll buy you out at 58% of the value of the equipment, which is really cool. But you get a giant tax break. Now, the downside to that is you actually have to prove that you are now you're active in the business. You can't be passive. So passive is you give somebody your money, they do all the work, and you get a royalty. You actually have to prove you're active. So you actually have
got to do the work.
You have to do some work. So you have to show at least 100 hours of documented work that you did running your business. That could be opening an email. That could be, we have a whole spreadsheet to help you document it. That could be opening an email. That could be looking at your QuickBooks. That could be traveling to a construction site just to check on your equipment. Whatever the case may be. But again, that's something else that's very popular. Another one that's popular is oil and gas. So you can do a oil and gas program, which again for accredited investors only. And accredited investors can then take their money. I think the minimum is, I think we can get in at $50K, but you can get it at $100,000 level, and they have what's called intangible drilling costs and some other tax code, tax perks, which I won't get too deep into. So you can get like 85% of your investment. You can get a loss against that. And then that also, given the price of oil is, can kick off an income. And the goal for that program, and you're drilling with majors. You're not drilling with wildcatters or drilling dry holes in the middle of nowhere saying, hey, there's hydrocarbons in there, and you're just drilling a bunch of dry holes and you never see any money. Right. These guys are actually proven. They're your Exxons, your Chevrons, your Marathons, your big oil companies. You're just drilling alongside of their drillers. So the people, they're subcontractors, and you're basically they raise the cash and drill the wells and give you an income stream too on top of it.
Folks, you are listening to On the Mark with Mark Papa. I'm Gary Byron. Mark is the president of Financial Resources Group. They're out of Glastonbury. You can find them online at FRPlan, F as in Frank, rplan.com. And you can call them. Call them right now. You can call them right as soon as the show is over. You can call them later today. You can call them tomorrow, Monday, during the week. Just call him. Schedule a no-obligation consultation. It's going to open your eyes. 860-657-8380. 860-657-8380. I'll give it to you one more time, more towards the end of the show. Let's talk S-Corp election for business owners. What is that, and what are some of the best practices? I should get that out of the way.
Well, this is something you do need your CPA for. So I would say
I don't know it.
Our CPA, who's wonderful, and says basically you should have about $80,000 in earnings or revenue, with one of the two, but about $80K at that level is when you can start considering doing the S corp. So the S Corp is very helpful because it avoids double taxation, and profits will pass through to your personal return. So it's an S Corp election for your LLC. You pay yourself a reasonable salary for payroll taxes, and you take the rest as distributions. So then you review your salary annually against industry benchmarks to stay IRS compliant. You'll file what's called the Form 2553 in a timely manner, and it's great for profits. Yeah, it says over 100,000, but it's about over 80,000 is where is about the minimum bogey for that.
Okay,
but that's something that I think is extremely important too, because then you can also, when you go to sell your business, you can then do something wise in selling your business as an asset. So it becomes an asset sale, and you pay a capital gain at the 15% long-term rate versus paying ordinary income on your versus your wages.
What about investing in solar?
Yeah, I mean, so there's a little bit of a limited window because some of that is starting to go away. With the OBBB.
Yeah, that's done this month.
There's I think another year left for most of that, but there's a plan that we have called the Solar Tax Equity Plan, and you invest in solar projects for 30%, what they call ITC, plus accelerated depreciation. So it's a pretty interesting way to go. And that's another one that we utilize. And I didn't bring a lot of information on the solar tax.
All right, how about one for this? Because Connecticut is getting more and more known for filming, from Hollywood East, film tax credits.
This is really cool, Gary.
Yeah, it sounds
The people who sponsor this program are absolutely brilliant, really brilliant people. And they came up with this strategy for people to go and invest and get these film credits. So what really triggered my mind, when you see someone like Rob Reiner, who says, I don't need a tax break, tax me more. Do you think Rob Reiner's paying himself with a W-2? No, he's got production companies, LLCs, partnerships, right? So it's kind of funny to see what a hypocrite Meathead is, because he is a total hypocrite. And then I sat on this call for about an hour with this state film tax credits, and there's certain states are better than others. But, Connecticut was one of those states that had the film credits. We see some Christmas movies were made here, and then, there's a whole bunch of stuff happening. But it's what they call, you can get the solar, you can get the film credits based upon based on the production. And what these guys were doing is they were smart. They were buying up these different productions, or they would create new episodes, and then they would try and stream it on Netflix. They were buying older things that hadn't been streamed on, let's say, less popular streaming networks, and making money and royalties on that. So, but they're able to make these films and get these nice tax credits, and you become part of it. And then as part of your your active hours, what you get to do is actually go visit the set. You get to meet the actors. So, like, let's say, I'm not saying you're going to meet Brad Pitt, but you might be, some of the actors who could be pretty famous who do these shows. And you actually can invest, get a tax break, and go meet some of the actors and have a good time. So that is actually a pretty lucrative tax break as well. But what really, really jumped off the page was the fact that here we're talking about all these Hollywood stars saying, tax me and this and that. They're investing in their own film productions, and let's not pretend that they're not out there taking advantage of these tax credits. So you might as well too.
All right, I've got about.
It's just a matter of getting your arms around it and understanding it, and you can go call your CPA tomorrow after you get off this call on Monday, and they're going to be like, I don't know anything about that, right? Or maybe they do. Maybe they do have somebody who does.
I got about 3.5 minutes, and I was even debating whether I bring this up or just save this for next week. I'm going to go for it. I just want to shift quickly to investments. Tax-managed custom indexes, they are popular. Just explain them, just quickly, the pros and cons versus the tax-managed products that you use.
All right, Gary. So basically, the custom index has become very popular because it's sort of a high net worth solution for people that have that. Remember, I talked about that concentrated position like Microsoft?
Oh, right.
So we use Microsoft as the example, okay? And let's say I have a huge position in Microsoft, and I don't have really much going on in terms of taxable tax losses. So what they do is they create this custom index around Microsoft, knowing that they'll buy 500 stocks. They're just going to buy the S&P 500. Now, you can buy the S&P 500 for free on your own inside of an ETF wrapper. So you don't buy it as an investment per se. What you are buying it is about a third. Now, don't quote me on this and don't throw me in jail because it's about a third. When I look at the S&P 500, I would say when you get down to probably 300, you start seeing the bottom 200 stocks all lose money.
Oh.
Right? So we've had this major concentration. I'll go into the Mag 7. I've been harping about that for a year now. But what happens is knowing that those stocks are going to lose, always about the bottom 200 stocks are always going to lose, what they do is they harvest the tax losses constantly, and then they do that to offset the big position that you have. I have a better way of doing things, way better.
I would imagine you do.
So there's that, and then we have a quantitative strategy that does daily tax harvesting. That actually is designed to make your money not automatically lose a third of your money, just does a better job managing in and out on a day-to-day basis. But they do that as well. But the one thing I want to talk about is the IRC 351 exchange program that is going to be launching. There's a couple sponsors out there. You have Wes Gray at Alpha Architect who's launching one, Meb Faber out of Chicago who's doing one, and then my group at Astoria in partnership with Wes Gray as well. They're working on an IRC 351. What it does is it takes your trap portfolio. Mm-hmm. You have a big tax trap portfolio. No more losses can be harvested. If you sell anything, it's going to cause a capital gain. And as long as that portfolio is compliant, and I won't get too much into the compliance because we're running out of time. No single security over 25%. The top 5 has to be under 50%. Transferors control 80% of the post-exchange, so it's only for new launches. They launch a brand new ETF, Gary, and they get everybody to put their money in. And what happens is when you're in the ETF wrapper, now you have your portfolio that isn't so diversified. Mm-hmm. Now you become part of the exchange-traded fund. So let's say you take your 20 positions, and now you have 100 positions, so you're more diversified. And it trades inside the exchange-traded fund, so they can buy and sell without any taxes. However, if you sell the IRC 351 symbol, your cost basis transfers in, you could get a capital gain. But it wipes out your capital gain and also makes you more diversified.
That's key information. Folks, if you like more information on this and any other topics that we discuss on this show, simply head on over to frplan.com, frplan.com, or pick up the phone and call Mark Papa over at Financial Resources Group in Glastonbury, 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.